buy the winners from the last year and hope that they continue to perform well in the future. And by the way, if I quickly go back to this strategy here with the betas, I don't know if I mentioned it last week, so this is a strategy that often is claimed Warren Buffett follows. So Warren Buffett buys assets which have small betas, right? And then they tend to have higher returns compared to the capital asset pricing model. So if you evaluate Warren Buffett's skill based on the capital asset pricing model, on paper he looks very good because he produces positive alphas, right? But again, maybe our alpha is just wrong, or the model is wrong, but he kind of uses this strategy. Sometimes this positive alpha here is dubbed as Buffett's alpha because it's the strategy that he follows. And there's even a paper called Warren Buffett's alpha that analyzes his strategy. So you definitely find investors like this. You can even buy ETFs that follow this strategy. It works similar with volatility, by the way. So low volatility stocks tend to have higher returns given the level of risk that they have. And there are people investing in these strategies systematically. And this strategy here is called the momentum strategy. And you will find kind of this being followed by professional investors and their ETFs, which are offered to do this. Of course, historic data is not a promise that, or not a guarantee that you will make the same returns in the future, but this is pretty long evidence. Well, for this one here, we actually have data from 1927 to almost today. So we have, by now, 95 years of data, and the pattern holds, so that's a very, very long sample. It doesn't hold every year, unfortunately, so usually when there is a crash in the market, the pattern, because also, it doesn't matter whether you're winner or loser last year, if there's a crash, everything crashes, right? So this is a pattern that mostly works in kind of upturns, market upturns. And then finally, if you want to see this in a picture, it's the same pattern again. So you have the picture of the capital asset pricing model here with the betas on the x-axis and the axis returns here. The red line again was our theoretical security market line. You can always kind of draw this by identifying the market portfolio. The market should be here, where the beta is 1. So you only need to know what the average return of the market was in your your sample, and that was probably roughly 7%. So these are axis returns. And then you draw a line through this point and the origin through 0, and then you have your theoretical security market line in this picture. And the empirical security market line, that's the gray line here, is just the line that best fits through the dots. Well, a straight line here doesn't really work out. You see that it's a nonlinear relationship. And you have an outlier over here, which kind of drives the picture. That's here the loser portfolio, right? It has a very, very high beta that continues to perform badly. And that's probably the winner portfolio. Right, but you see that it has roughly the same beta as the market, so these betas are very close to each other, but you have a bunch of assets which perform better than the market. Right?
It's based on the previous numbers, right?
Yeah, it's not fully the same because here, because of a lack of space, I present only 5 portfolios, and the next picture there are 10.
Yeah.
Right, but if you combine the 2 worst portfolios, you will have this loser portfolio. So it's not exactly the same. Right, so probably these 2 portfolios here, this is 10%, this is 10%, and they make up the 20% portfolio from the previous page. Yeah. For just showing 5 points here would not be kind of a good graph, so it shows to have more data here, and just because of space.
Yeah, but the logic is the same, right?
Yeah, the logic and the idea is the same. Right, and you do this basically only once a year, right? So usually they take the middle of the year. So if you use accounting data, that's published kind of at the end of the year, and then it takes some time until the reports are printed and the shareholders' meetings are, so you have always like a little time gap, so that you can say that everyone knows the information. And then you do the sorting usually by the end of June, and you look at what was the previous year's winners, losers, and then you wait 1 full year. Right? It's not even a strategy that you frequently update. Right? You could do this on a monthly basis and probably do even better than this. Okay, so there are actually hundreds of these factors. I think in total there's one paper by Campbell Harvey and with co-authors, which are usually forgotten to mention. So you only always mention the first guy, not the other ones, but probably the other ones did the work. So Harvey is a very senior guy and he did it with his PhD students. So the doctoral students probably compiled the list. So they went through all the papers and made a list in a spreadsheet that you can download with all the different factors. So they say, okay, this was the variable they used for sorting. This is the paper where it's published. So you have a very nice list. And they say something about the effects. And they group the effects actually in different variables. Is it a macroeconomic variable, a firm-specific variable? Is it balance sheet data? Or what data has been used? So more than 400 different factors. These things are called anomalies in the literature. So an anomaly is an empirical puzzle that's not explained by the Kapp-Lesser pricing model or any other theory. And there are some which are very frequently used, and others that are kind of not really got much attention. So we looked at the first two here, the low risk anomaly, right? So the stocks with low betas have higher returns than they should have, and the momentum effect. And the ones here at the bottom are actually the most famous ones, and they have been developed by Farmer and French in their original paper. So Farmer got the Nobel Prize. I don't know why French didn't get it with him. So they looked at the size effect. So this was my first example, right? You can do sorting by size, and they actually find that if you compare two companies which have exactly the same beta, but one is just a small company, the other one is a big company, he finds that the small companies will have higher returns than the large companies on average. Here we actually have sort of an idea why this could be the case. So higher returns means more risky, right? So that's kind of our standard way of explaining this. And the idea here is basically that the large companies, they're well known, they're covered by analysts, they're covered in the media, so there's less uncertainty around how the company's doing. While the small companies, they're less known, there are less people following it, so usually for the big companies you might have 10, 15 analysts following it, so you have 15 different opinions about the company. And for small companies it's hard to find any analyst to cover it, right? And maybe if these are local companies, like how do you find out about a German company if you live in the US? Or how to find out if you live in Germany about a Chinese company, right? So even a difference in language, that's a problem. Right? So there's just much less information about the small firms and much less coverage in the media. Right? So if there is a problem, you're much less likely to get to know about it quickly. Right? So information flow can be considered as a risk if you have less access to information. And that's why you want to have a risk premium to hold these small stocks. Right, so that would be a risk-based explanation for this effect, which I think makes sense. Then we have the value effect, and they use the book-to-market ratio to measure this. So value stock is one where you have quickly see, because sometimes you can have the book-to-market and the market-to-book ratio. I prefer this here. So the value stocks have a low market-to-book ratio. That means probably they're right the same. Right? Book values and market values are very similar to each other. They're called value stocks. And the opposite one is if you have very high market to book ratios, your market value is much higher than the balance sheet number, and that's called a growth stock. Can you maybe give me examples for value and growth stocks in the real world? We just have some pictures in mind or companies in mind. Or industries maybe. Which industries tend to be value stocks and which one tends to be growth stocks? Think about what drives the difference between market and book values. Is there something maybe incorporated in the market value that's not in the balance sheet?
So growth stocks, just to clarify, growth stocks has
Very high
its
market.
price is more than
The balance sheet number.
yeah.
Exactly. So measured by equity actually there. So it's the market value of equity is higher than the book value of equity. So there are two ways of interpreting this. So the first one will be to find something that's incorporated by investors in the market value that you don't find in the balance sheet. And there are actually a couple of things that are included in the market value that make sense and create value, but that you are not allowed to put on your balance sheet. Yeah, so that would be one thing.
Yeah.
What is a goodwill?
The
No, actually, the goodwill is on the balance sheet, but you're after something correctly here. So.
yeah, that's why I say it's very silent because I remember the balance sheet that we actually put it.
So, but what is the goodwill?
Like the difference between the balance value and sell price.